Welcome to the daily update, where I'll go over the action in the market for Tuesday, October 21st, and we'll see how things look for Wednesday, October 22nd. Pretty sleepy day. It was really more of a positive day, though. We saw the parabolic SAR go from negative back over to positive, and we're seeing some general improvements that I'll go through here. So the market's holding up for right now, even though we were virtually unchanged with the S&P. The Dow had a good day. Some earnings reports came out that were well received, and so that really helped the Dow outperform the other indexes. The Nasdaq 100 were down a little bit. Small caps had a pretty good day. Mid caps had a good day. So we're seeing general improvement across the board, even though not really big swings as far as price. So right at the open, we had a lower open though, not much, didn't gap down or anything. We were pretty much flat, and then we went down right after the open. We got down to the daily pivot at 67.23. Then we found support there, and we rose above the unchanged level to go positive. But then we hit resistance. We never did get to R1, but resistance was at 67.50, a round number. And so that's where things pretty much topped out. Then we chopped between the unchanged level to the downside and 67.50. We tried to get through it a time or two, but just weren't able to do it. And we closed virtually unchanged on the day. So from a percentage basis, we were up a couple of less than a point, like 0.22 or something like that, a quarter of a point. So it goes as an up day, but from a percentage measurement, it didn't really change at all. But we were slightly above average with volume, even though there wasn't an awful lot of price action during the day. Now we're still positive on all three time frames. We're above the 20 period moving average in the short term, and we're still well above the 50 and 200. So short, intermediate, and long-term trends are still positive. We're still seeing interest rates coming down. We're under that 4% level, and that could be helping things. If interest rates are coming down due to market forces, not so much the flight to safety, which that's what we were seeing last week. We saw last week prices coming out of stocks and going into bonds. That's why interest rates were falling. Now they just seem to be drifting lower, not so much out of fear, but just because the market sees it that way. And we don't really have much of a read on inflation. The government shutdown's still going on, so we don't have any economic reports to deal with there. Of course, there's all kinds of geopolitical things that are happening, but including the government shutdown, but the market just doesn't seem to care all that much. There wasn't an awful lot of news that came out that really drove the markets. So the Dow did hit a new all-time high, and financial media loves that. And people that do follow the Dow, they're like, oh, yeah, everything's great. And mega caps and tech didn't really have that great of a day. It wasn't terrible, but they underperformed when you compare it to the rest of the market. And earnings were in the middle now of earnings season, and that has been helping the market to stay more positive. And one of our primary indicators, the parabolic SAR, has now turned positive. So that's kind of a big deal because it had been giving us a negative signal there for a while and kind of mixing up any kind of a consensus. And we still have what's on the list now was on the list yesterday. Not seeing really strong conviction in the short term, but we do have a couple of indicators. The Williams percent are and the stochastics are showing positive momentum there. No change to the scenario, and this is pretty much what we've been going with, is that the Fed's gonna cut rates in October and very likely to do so in December. And the October one, that's like 99%. And so it's pretty much a lock-in that will happen. And then the dollar was up, didn't really seem to pressure stocks. Now, gold got hit pretty hard. A lot of profit taking came in, and everyone's going, oh no, what's going to happen? Are we going to go sideways now for the next 10 years or something? But it's been the craze lately. And part of that could be the dollar has been seeing a bit of a bounce, and that usually gold and the dollar tend to go in opposite directions. And interest rates continue to fall. We're at 3.96%, where we had been at 3.99%. We're still negative as far as sentiment. We actually ticked down one notch. We had been at 30, which is negative. Now we're at 29, so that it's a little bit of an erosion there, but we had been improving generally. We got down into like 23 and then we were bouncing up. So even though the number was negative, it was showing a sign of improvement, but really not much of a change here. We're still not positive yet though with our trend. We're improving, but we still see the ADX going down. We could actually go into more of a non-trending type of an environment. We've already been not trending. All last week was just chopping all over. And so far this week, we're not really going anywhere. And the ADX is starting to pick that up. And we might end up going into a trendless environment, but we're still negative with the red line above the green line. We're above 20 though, but that's coming down. And I'll show you those charts. And I kept the bias at positive because we were just up a little bit there, but it was really not much of a change. And I'm keeping the momentum at mixed to positive. Mixed, there's still some things to be concerned about, and we have a down day, and that could really get in the way of some of the improvements that we've been seeing. But if we have an update, that could continue to build more of the positive stance that seems to be developing here. All right, we didn't have any economic reports. There weren't any scheduled, but even if there were, they probably wouldn't have come out because of the government shutdown. So there's no charts to show there. Every week we get the overbought, oversold composite. It's still coming in pretty high. It gone above 90 here. Now this is longer term, and you can see this goes all the way back to 2000. So it's a 25-year chart almost. But we had dropped down here, and then we're coming back up a little bit in the 81 range. And usually when we get to the high 70s, low 80s, that's when the market is considered to be overbought, according to this chart, on a longer term basis. And then volatility implosions. We saw the VIX really drop. We had been above 20 with the VIX last week, and then it really came down on Friday, and that's what they're calling a volatility implosion. And they're quite bullish. So Carson has some research here that shows when we see a big drop in the VIX, what happens after that. So you can see the green diamonds here, and then what ended up transpiring, and it usually was a positive sign going forward. The actual numbers are over here in the table, and 1 month, 3 months out, it's still very good, 83 and a third, but you go 6 to 12 months out and it's higher 100% of the time. So this way of analyzing things does look better going forward. And then realized and consensus year over year earnings per share growth for the S&P still looking pretty solid in here. Now it is dropping down a bit in going forward, but it's still positive nonetheless. And then weekly change in equity positioning. It's the what was happening last week, and it still could pick up again, but it seems to be subsiding right now. We were seeing a similar type of market environment to what we saw last March when we got ready to really go down because of all the tariffs. Well, this news between China and the US that spooked the markets last week, but it seems to not be having as much of an impact right now. But that could change at any time. And so we see a lot of positioning getting more defensive here. It's like, uh-oh, we're getting ready to head lower like we did last spring. We better get out. Now, this isn't price. This is just positioning in stocks. Then commodity trading advisors' exposure to equities, it also dropped in this latest reading, but it's still well above the zero level, still heavily weighted in stocks there. And then PE valuations, we get this every day or every couple of days here, just telling us what we've been seeing now for years, that the market is overvalued. Right here in about the middle, we have the S&P coming in at 23. When we get above 20, the market is considered to be expensive. The Nasdaq 100, those are the big growth stocks. That's the most expensive at 29. Now, again, and I point this out, I use the S&P 600 because it lines up with these other indexes. The Russell 2000, it's a small cap index, but it's calculated in a different way, and it gives us this kind of disproportionate PE ratio here. It's not doesn't really work well to come up with consistency across the different PE levels that we watch, but a lot of folks still use that anyway. And mid caps, as well as the equal weight, they're more fairly priced. Then going in, looking at this chart on a year-over-year basis, this is now the fourth major spike in investor euphoria since the late 90s. Okay, people are getting all excited about things. And a lot of this is now AI driven because everybody wants to be involved in AI. And there's probably some bubbles in there somewhere as the market works its way through and really big expectations of what's going to happen. And then people get frustrated when it takes longer than they think it will because we want instant gratification and we want our stocks to triple in 3 weeks. Then when that doesn't happen, people get a little bit apathetic, and then we see some declines, and then the market's working its way out. What's going to work, what's not. So this is more euphoric times. And so what happens is a lot of people buy things on margin. And we're getting up above this red dashed line here that there's a lot of margin out there, which is okay as long as we're going up. If we do start to see some kind of a decline, people have to pay that money back. And that just kind of feeds into the selling as well. So when we get up to a higher level, we can still go higher than where we're at right now. But you can see this was the dot-com boom and then bust. This was the great financial crisis. And then we had, of course, the whole COVID thing that led to 2021 being a good year, but then the bear market in 2022. Then breadth of earnings beats is at levels usually only seen of coming out of big downturns. That could be positive. And here's Deutsche Bank here just saying that, all right, they're revising their earnings to the upside, which is usually what we see after we've been through a recession or some kind of really difficult time. And so that could be taken as positive. And then hard data versus soft data. Pay attention to what consumers and executives do, not just what they say. Like hard data would be the economic reports that would come out. Soft data would be how people are feeling about things. And says no cheer heading into the holiday season. Not really seeing things all that positive now, where the light blue line, that's the soft data. That's actually dropping off, where the hard data seems to be holding up okay. And then gold drop, it really got me. And so now you got a lot of people freaking out thinking we've hit a top and whatever. The last time gold dropped this much in a single day, it spent the following 3.5 years going sideways. And after it had doubled in a year and a half, it wouldn't be surprising if this is a consolidation phase. And there's something to be said for that because gold, you've got these gold bugs out there that just love gold and they're sure it's going to really go up and they get people, but they keep saying the same thing over and over, so people get lethargic about that. It's like, oh, they've just been saying this all along, and then it finally happens, and then they jump in so that they don't miss out on that, and that usually is about the end of the party as far as gold. That's one way of looking at it. Now, the other reason is, why is gold going up? I mean, it's astronomical right now, and gold is usually used to protect against inflation. Well, inflation isn't that big of a deal. Well, it also is used when insanity is out there. There's a lot of insanity in the world right now, and that could be another reason why gold has been going up. So now we're just seeing a pullback in that. And it was a big downward move, a 1 day percent change. It really came down more severely. But is this going to lead to more sideways action? Because if you go back earlier in 2025, when we were really going down with stocks last spring, gold was going up. And then as stocks were going back up, gold went sideways there for months. Then it finally broke out again. So that's what we'll be watching for to see the relationship between gold and stocks. That's why I watch all these different things, because you can pick out some insight as to what's actually happening. And then defensives against the S&P, even including utilities, which have performed better as late. Again, the debate is there whether are utilities a growth area now because of AI and EVs and things like that. Um, if you even include utilities in that, this has been the second worst 3 year stretch for defensives. Yeah, we've been growth. It's been the mega caps. It's been tech. It's been semiconductors. That's what's really been driving the market. As the defensive areas, staples, toilet paper, toothpaste, they haven't performed all that well. And it's trailed by 52% more than the run up to the dot-com top. So this just kind of shows what we've been seeing now for quite some time is the underperformance. Then this is put out by Edward Yardeni, but it was included with the other source that I use for these charts. It says the 3 month percent changes in both forward revenues and earnings remains very strong. It's come down a little bit here, but it's still looking pretty solid, and that's what the stock market likes, and that's more of a positive thing. All right, so kind of a sleepy day overall, where we had pretty much a flat open, but we immediately went down. We did set the low right at the daily pivot and then came up, got above the unchanged level. Never made it up to R1. We hit resistance here at the 6750 level and just kind of chopped around between 6750 to the upside and the unchanged level to the downside. And just not a lot of conviction as far as price movement on the intraday chart. And pretty much unchanged in the initial overnight session. We were a little bit more positive here before the market opened, and then we saw that dropping down. But it was a pretty quiet day as far as price is concerned. And value did outperform growth intraday, so we have the red line above the blue line. And we still haven't really broken out. Now we've just come back to the high end of this range that we've been in. But again, looking at the bigger picture, we go back to the beginning of August and we see this generally going up overall. And now it's just kind of plateauing right now. Is it just taking a rest before it sets to go higher? Or are we going to see some kind of a pullback? And not looking all that strong now with the growth to value ratio intraday for the S&P. We're actually under the moving averages and we are declining at this point. So it was not a good day for growth. So growth was down for the large caps where it was value was up, and but for the mid caps, growth did pretty well. And for the small caps, growth was up a little bit more than value, but we were virtually unchanged. The middle area here, these are the ETFs. This would be SPY in the middle here. And so the small cap growth to value ratio still range bound, but still looking positive, even though we generated a recent death cross with this. And a little bit of an improvement with the mid cap growth to value ratio, but still declining here with S&P growth to value. We're underneath the 50 period moving average. We're going the wrong way if we are more positive, if we're going to get more offensive rather than defensive with the market. Now, in the bigger picture, we're still in an uptrend though, and still holding up okay with this growth to value ratio here. And we did see an improvement. We got back above the 50 period moving average with discretionary to staples. So that is showing some signs of improvement. Discretionary was up where staples were down, and that helps the overall ratio. But we're still just going down, down, down here with the ADX. That's the black line here. We're below the moving average. So it's a weaker trend, but we're still above 20, but it's also still negative. Even though the red line's coming down and the green line's going up, we haven't crossed yet. This is the short term. Seeing a very similar thing with the intermediate term. Weakening trend, still negative, has not crossed over positive yet. And we did pick up here. We were just a little bit above the average level here with volume. Then looking at the gamma exposure, it's all green, so that's positive here. We do have some resistance here at the 6750 level, which is where we topped out in Tuesday's session. So it's not really any surprise that the market had a difficult time getting through that. And it's also a round number, which is where strike prices are at as well when you look inside of options using the Greeks. And one of those Greeks is gamma. And then still a little bit above the moving average and going up with the Ulcer Index. So this is suggesting fear is still coming into the market. But we continue to drop with the VIX, both with the line chart. It's coming down below 20, and we're also dropping down here with the bar chart. We're still above the moving averages, but the VIX is calming down a bit, at least for right now. So we did see that move up. That was the October 10th. That was Friday when everything was going good. And then President Trump said, "Oh, we're having some trouble between China and the US here." And stocks just tanked 2.75%. Well, we've been settling down a little bit here as far as the VIX. And also coming down with the VIX of the VIX. We're coming back down, at least with the bar chart, getting closer to the moving averages. But we're still above the moving averages with the line chart, which is the closing value, and just barely into this red area with the skew index. And so this means the market's still anticipating some kind of a big move, but we don't know if this is going to continue to go up or if it's topped out for right now and it will start to come down. And did see a drop off with the daily equity put call chart. So we're going down with the 5-day chart, and we're actually rolling over just a little bit with the 10-day chart, which had been negative because these both the 5 and 10-day charts were going up. So we thought, uh-oh, maybe we're putting in some kind of a top in the market. Well, now they're starting to reverse and come back down. So a little bit of a contradiction here. A tick up with this fear gauge and a tick down with the other fear gauge. Usually we like to see confirmation with both of these charts going up or down at the same time. And coming down with the volatility risk premium, coming further into the range. So this shows fears coming out of the market as well. And still looking good here, setting another new all-time high with the advanced decline line based on price and volume. So the advanced decline ratio, short and intermediate term, that's still looking positive. Still above zero, not showing a lot of conviction with the advanced decline oscillator, but it is positive. And we're seeing a bit of an improvement here, more green than red, even though the green is not really breaking out. It's more that the red is vanishing now. And so the 5-day chart is starting to turn, hasn't crossed the moving average yet, but the 10-day chart is still continuing to go down. And looking good here with the smart money indicator, accumulation distribution. Still, even though it rolled over a little bit, we're still above the moving average. Looking at the boom indicator, but we're still declining here with the chicken money flow. Now it's flat at this point, so you could say it's still declining in the bigger picture. We need to see this bounce back up and actually see the red line turn up. But for right now, the red line, you could say declining or flat as well. But we're positive with the chicken oscillator. And we're just hanging on to being positive now with the vortex. The green line's above the red line. And we are seeing general improvement here with the advanced decline line studies. We're back above the moving average with the NYC common stock, setting a new high with the S&P, above the moving average with the mid caps, improving but still below the moving average with the small caps, and above 50 and going up, but still not breaking out of this series of lower highs here, this negative divergence when we look at those stocks in the S&P above their 20 period moving averages and above 50 and improving with the 50 period moving average study. Also, we've been seeing a series of lower highs here. It'd be much more positive if we could break above those. And an improvement with the 100 period moving average study and 200 period moving average study. So just kind of not setting a new high here yet for the S&P, but not all that far away from it either. And we were just a little bit above average with volume. So we're seeing a general improvement here with the 20, 50, and 200-day moving averages on the S&P. Still above the midpoint with the Stochk RSI. Still showing good short-term positive momentum with the Williams percent R. Above the midpoint with the CCI 14 and 20, but not showing real strong conviction in the short term. So the short-term stochastic, though, it is still extreme. We are improving with the intermediate short-term stochastic, and we're trying to cross back above the moving average with the long short-term stochastic here. Still above the midpoint, still positive with the force index, still above the moving averages. The longer we stay above this, the more these three moving averages will start to turn up. And seeing general improvement here with the short-term trend. We had been declining with the green line and the blue line. Now we're above that, and so the lines are starting to turn up. And we're above the 20 period simple and exponential moving averages. So we just could not get above that last week. So far, Monday and Tuesday of this week, we've been able to get above that and stay above it. And we're in the +1 channel with the standard deviations chart. Now moving on to the intermediate term, we did decline. The balance of power didn't pick up a lot of strength here, but we're still hanging on to being barely positive with that. We're positive with the go, no-go system, and we're still above the midpoint with the highest high value chart. Day 120 now, the Landry Light, that's the uptrend going back all the way to the beginning of May. A little bit further into May, we have the proper order. That's on day 114 of its uptrend. But we're still not seeing any strength with the TTM squeeze. Not a lot of follow-through weakness either, but just kind of not really giving us much to work with at all here. That would be a negative divergence. And still just barely above the moving average with standard deviation. Now, if we hit more of a trendless environment, this is really going to slow down. But for right now, it's still above the moving average. That just tells us the speed that stocks are going either up or down. And we're still below zero with the ease of movement, and we're still below zero with the Arun. It really fell off there with the latest reading, but we're positive with the S&P McClellan oscillator. So this is continuing to improve. We're trying to break out of this series of lower highs here. That could be positive for the S&P itself. So we're going up with the summation index based on price and volume. We're above zero and trying to improve, but haven't quite broken out of these lower highs yet with the NYSE McClellan oscillator. But we're starting to turn up with the summation index based on price and volume for the NYSE. Still positive, but slowing down a little bit with the soil and trading oscillator. And we're still negative when we look at the PMO. We're below the moving average. But when we break it out based on price, that's showing an improvement. And we're also crossing back above the moving average when we look at just volume as well. So there's some internal improvements there. Also, still above 50 and going up with the PMOs that are rising. The buy signal's still under 50, but they are going up. And we're trying to turn up with the PMOs inside the S&P that are above zero. Positive with the Elder's Impulse system, and then a switch here. We've gone from negative to positive with the parabolic SAR daily chart. And trying to improve, but haven't quite crossed back above the moving average with the slope oscillator. We're still below the moving average, but improving with the MACD. So short term, we're seeing some improvement. We're trying to turn up in the intermediate term, but with the two long-term oscillators, TRIX and KST, they are continuing to decline. And we're still negative with the Copic curve, and we're flat, but still positive with the Sean trend meter. Still above 50 with the money flow, and above 50 and going up with the ultimate oscillator. Above the moving average with on-balance volume. Above 50 with the intermediate and short-term RSI, even though they didn't change all that much. And we are positive with the bullish percent index. We dropped a little bit below 50, then we bounced. Now we're above the moving average and starting to go back up. That's positive for the S&P. A little bit of a tick up with the NYSE bullish percent index, and we were flat with the Nasdaq 100 bullish percent index. The intermediate term trend still trying to improve here. We're just kind of going flat, but the blue line and the red line, they're trying to turn up, but we haven't been able to get back above these lines at least yet. So we're above all the moving averages now. So that's why we're positive in the short, intermediate, and long term. And we are more than 10% above the 200-day simple moving average. That's when we want to start watching this. And the mass index, two out of the three criteria have been triggered. We're waiting for this line to come back down to the red dash line, and that tries to indicate a reversal. And still above this little mini rainbow, we've really flattened out with all of the lines there, but we are above it. So that's still looking fairly positive that way. Still looking pretty good with our weekly chart. We're well above this R1 pivot point. We were unchanged, so we're still up 1.07% on the week, but all of that was from Monday. Nothing was gained on Tuesday. And we're improving here with the Heiken Ashi with open candles. So that's showing some improvement there. We're positive with the Kegi chart, but we're still negative with the Renko chart and the three-line break chart. So not across the board confirmation there. And we did get some new X's drawn in here. We had enough of an upward move to trigger this. So that's positive, but we haven't been able to break above the 67.50 level yet. Long term, we are seeing a general improvement with the 150 and 200-day moving averages here. Positive on all time frames because the mid caps had a pretty good day. They were the holdout to being negative in the short term, but now on all time frames, the indexes are positive. And we're negative with commodities in the short term. And we're watching the dollar in the short and intermediate term because if it keeps going up, that could put some more pressure on gold. And kind of split down the middle here with what was positive and negative. We had discretionary, and that helped the discretionary to staples ratio improve. That was the strongest area. Now, we need to see more follow through with that. It would be nice if that could kick back into gear. But then you had utilities that were down the most, and staples ended up falling as well. So some red to start off with. Canada falling below 30,000. We had a BPI cross below 50 with the industrials. Then things started to improve a little bit. Healthcare, BPI crossed above 70. That's a defensive area. And then the Dow going above 47,000, setting a new all-time high. The Nasdaq getting above 23,000. But then the materials later in the day had a BPI cross down below 30. So both Google stocks ended up being red. Nvidia was down. Apple was up a little bit. Microsoft up a little bit. Amazon, even though Tesla was down, Amazon's really what helped the discretionary area overall. And then Walmart got hit. That's the biggest area of staples as well. But still some red in here when we look at the tech sector. Then the Dow, we did hit this R1 overhead resistance level, but on a closing basis, the Dow has now set a new all-time high. And we're positive with the Elder's Impulse system. And not much of a change, down slightly with the Nasdaq, but still positive with the Nasdaq with the Elder's Impulse system. Down virtually unchanged with the Nasdaq 100, but still positive with the Elder's Impulse system. We're trying to improve with the momentum, but we have not crossed above the moving average at least yet for the Nasdaq 100. And we're up 1/4% here with the S&P 600, but still awful lot of noise, awful lot of choppiness with the small caps. And the Russell 2000 small cap index was actually down. So that's strange. You go back to this previous one, we were up with this small cap index. We were down with this other small cap index because they're calculated in a different way. But we're still positive with the small caps. Now, this Elder's Impulse system, it's the IWM, which is the ETF for the Russell 2000. So even though it was down, we're still green over here when we measure what's the short-term trend. And mid caps breaking, staying above their 50-day moving average and getting above this pivot point and positive with the Elder's Impulse system. The Wilshire was virtually unchanged, hanging out above its 50-day moving average, as is the total U.S. stock ETF. And we were down a little bit with the financial sector, having a difficult time getting back up to its 50-day moving average, and continuing to see what we've been seeing since last spring, how the financials are underperforming the S&P. The FANG index up just a little bit here, but hanging out above its 50-day moving average. Apple was up 0.2%, really small gain there. Amazon, one of the stronger stocks, finally breaking above its 200-day moving average, up over 2.5%, and above its 50-day moving average with Microsoft. Google saw a pretty big drop here, but it's not too far from all-time highs. And Meta, virtually unchanged, still under its 50-day moving average. Nvidia dropping a little bit, but still above its 50-day moving average. And Tesla was down a little bit over 1%. Really a lot of choppiness lately with these really big stocks. And Netflix, now they're going to be coming out with earnings, so there might be a little bit of a bump up here. We'll have to see. They've been able to get back above their 50-day moving average. And again, we've been seeing a bit of a drop off with the world to US stocks, the short-term correlation, where the longer-term correlation is still holding pretty steady. And oil was up a little bit. We're getting more into the 57 range now. And we're starting to come back down. You know, now I drew this line on here, so it's probably not perfect at all. But just about the time we hit this resistance level, then we see a big down day with gold. So a lot of people are seeing this particular relationship and saying, oh, well, maybe we better take some profits here. We'll see if this continues to fall or if we're able to break out and set a new high with this overall ratio. I wanted to show this because we're seeing some improvements here. The top two charts are discretionary to staples, but we have the weighted version on top, and that is bouncing back up after it had been declining. Then we look at the equal weight version because Amazon and Tesla account for a huge part of discretionary. That's still improving as well. And we're seeing an improvement with the tech to utilities. That's growth to value. Biotech is doing quite well compared to healthcare. And then this had really been going down. This is hotels to utilities. But now we're seeing a bounce here. So we like it when these are going up. If that can continue, that would be more positive for the market. And looking at the bellwethers, the semiconductors just coming off of recent highs here. Home builders are trying to improve, probably as interest rates have been going down, seeing a bit of an upward move with the transports. Retail trying to improve a little bit here, and regional banks, after really getting hit last week, we're not getting any more news yet about banks having any kind of problems, at least yet, the smaller banks. So now we're seeing this starting to come back as well. And then the three key risk on sensitive groups are challenging for these are the volume weighted moving averages from the April lows. Banks, builders, and Bitcoin, the three Bs. All right. These levels mark the price average investors that they paid since that day, an important threshold to watch. And right here with the regional banks, these are the smaller banks here. We're still holding out We came down below this anchored weighted moving average. Now we're starting to come back above it. The home builders also hanging out and starting to bounce back above this anchored weighted moving average as well as Bitcoin. So this is seen as a positive development. And the dollar, still in a downtrend, but it's been bouncing up as of late. And we're still below 4% with the 10-year yield. We're going up with the 10-year based on price. Still looking good here with the Qs to S&P growth to value ratio. Improving, finally coming back above the moving average when we look at discretionary to the S&P and still barely above the moving average when we compare large cap growth to value. So we're actually dropping a little bit down below the moving average with the large caps, coming back above the moving average with the mid caps, chopping sideways above an advancing moving average with the small caps. And we just want to do an update here. If this is new to you, here's the 3 points of criteria for the Hindenburg omen. And we have not seen another spike. We have until November 7th for that to happen, or this one will fall off the radar. And then we're also watching the Zwag NYC breadth thrust. A little bit of an upward move. We have until October 24th, which is not too far from now, to get all the way up to this red line. So we're going to have to see some pretty powerful upward moves for this to generate a signal, which would be quite positive if that happens. So what's our outlook? We're positive on all three time frames, and we're going to get the MBA Mortgage Applications Index. Even when the government's not shut down, this is not a major report. So it's another really light day as far as economic reports are concerned because the government shutdown still continues. And then all the geopolitical things that are happening that the market seems to be ignoring. But the one to focus in on is what, if anything, is developing between US and China as far as the trade. And then we're supposed to get initial claims on Thursday, but then CPI possibly on Friday. But who knows what's actually going to be coming out there. Now, I don't follow the crude oil inventory so much, but a lot of people do. But that'll also be released in Wednesday's session. Seasonally, just we are negative though. When we look at October 22nd, going back to 2002, this is not very good for all three of the indexes. We'll have to see how it plays out here. And we are still going through the week after options expiration, which tends to be down more than up, going back to 1980. So a little bit flat here when you just break out post-election years. Not really anything all that weak or strong either. And we are in the second half of October, which tends to underperform the first half of October. And this is a newer chart here. This is just showing how we're matching up with some seasonality, and it looks pretty good if you look at seasonality going into the end of the year. And we're still seeing a lot of companies on blackout because they're reporting earnings, but that is continuing to taper off. So, as far as what's negative, we still have the ease of movement. It has not been able to get back above zero. We're improving, but we're not positive yet with our momentum oscillators there. And the momentum oscillator for the Nasdaq 100, improving, but not positive yet. And we have an unconfirmed Hindenburg omen that will be watching until November 7th there. And then on the positive side, you could call this positive with accumulation distribution. That's still looking good. And the Chaikin oscillator is positive, but we're flat, although improving with the Chaikin money flow. And we are positive with the S&P and NYSE McClellan oscillators and summation indexes. The parabolic SAR, new addition, back to the positive side here. Longer term, the growth to value, discretionary to staples ratios, positive. Shorter term, not really doing all that well when we apply it to the S&P, still below that 50-day moving average. Swell and trading oscillator is positive, as are the bullish percent indexes for the S&P, Nasdaq 100, and NYSE. Money flow is positive. Ultimate oscillator is positive. The vortex is positive, and the financial sector by itself, but as I say over and over, still underperforming the S&P. And then the long-term daily and weekly chart for the special K oscillator. And we're watching for a Zwag NYC breadth thrust, but we're starting to get close to running out of time for that to happen. All right, and then here are the pivot points for Wednesday's session. So our conclusion, not really any changes here. We're still above the 20-period moving averages in the short term. That's why we're positive. We're well above the 50-period moving averages in the intermediate term and seeing some improvements. The parabolic SAR turning over to positive. That's encouraging. And we are positive in the long term, but we're more than 10% above the 200-day simple moving average. That could mean that we're starting to get overextended longer term. But we could go to 10, 15% around there before this finally becomes more of an issue. So thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.